Hey Collier family, welcome to our Q1 update. If you saw our 22 Outlook video earlier this year, we spoke about the volatility we expected coming in the markets. Boy did we ever get it in this first quarter. We never could have imagined that we would squeeze so much into the first 90 days. As you can see, both the United States stock market index and bond index were negative for the quarter. It's certainly interesting times we're living in. That does not happen all that often. There's obviously a lot of fear in the markets right now. We felt it was important to address the top 3 items we're hearing from clients today. Let's start with the issue that's top of mind for all of us, and that's the conflict going on in Ukraine. From a humanitarian crisis, what we're witnessing on our TVs on a nightly basis is horrendous. Unfortunately, when we're looking at this from a financial perspective, we have to take our humanitarian hat off and look at this from a numbers standpoint. The GDP of both Russia and Ukraine do not represent a very large portion of the global economy, and certainly don't represent a significant difference to the United States economy. We're all feeling the effects of this conflict at the gas pump, and we think agricultural commodities will continue to feel this effect. The things we have on our eye on most with this are energy prices in Europe, as they are much more dependent on Russian energy than we are here domestically. Also, the involvement of other nations. Does this turn into a larger NATO event? If and when does China get involved? These are the things that we're keeping an eye on going into the second quarter on the effects on our markets and your portfolios. Our biggest concern domestically remains inflation. We mentioned this at the start of the year, and we saw inflation continue through Q1 with readings the highest they've been since 1984. We're feeling it in all aspects of our life. We've touched it at the gas pump, through the grocery store, through every area of our life. The Federal Reserve has done what they communicated they were going to do. They raised interest rates this last quarter. They've communicated they want to raise it even more aggressively going forward. Generally, this means brakes on the economy. Doesn't mean bringing everything to a screeching halt, but it does mean that we're in the later parts of the cycle. So what we'll be watching in this upcoming Q2 and Q3 are, do these policies actually have an effect? Are we seeing inflation start to top out? One of the biggest questions we're getting from clients these days is, are we going into a recession? Just recently, one of the media's favorite recessionary indicators occurred. It's called a yield curve inversion. This is when the interest rates on short-term bonds are actually higher than the interest rate on long-term bonds. Does this mean we're going into a recession immediately? The answer is no. LPL research found that after the initial inversion that just occurred, on average, a recession comes 20 months later. They also found that 12 months after the initial inversion, markets are actually up 5 out of the last 6 times this occurred. So are we going into a recession? Eventually, yes. That's a normal part of any economic cycle, but the numbers simply aren't saying that that's on our doorstep right now. Well, there you have it, Collier family, your Q1 update. It's been quite the quarter. We haven't had one like this in quite some time. We thought it was important to let you know what we have our eye on, the things that are informing the decisions we're making on a daily basis, and most importantly, that we're paying attention. So from all of us, stay safe out there, and we hope to see you soon.